The world has been stuck in a prolonged economic slump since 2007, and it's likely to continue for the foreseeable future. Many people might disagree, thinking, but we're not in a recession. And yes, if we go by the technical definition, a recession is 2 consecutive quarters of declining GDP, rising unemployment, and a few other indicators. According to the National Bureau of Economic Research, we're actually in an expansion. In fact, we've been in the longest economic expansion in modern U.S. history, over a decade now. But here's where things get nuanced. People commonly misunderstand what a depression actually is. The assumption often goes like this. If a recession is 2 quarters of negative GDP, then a depression must be something worse, like 6 quarters of GDP decline. But that's not the definition. A depression is more about long-term below-trend growth without any tendency to either collapse fully or return to the trend line of robust growth. Let's take the United States as an example, although this can apply to other parts of the world as well. If the long-term growth trend is about 3.5% per year, that's generally what economists consider normal growth. But since 2007, the U.S. has been hovering closer to 2%. It might not sound like a big difference. What's 1.5% between friends? But the impact of this gap is profound. Over time, that difference accumulates, creating a wedge between where the economy could be and where it actually is. Over a decade, this gap has resulted in trillions of dollars in lost potential growth. Think of this as a growth gap, or an output gap. Since 2007, the U.S. economy has missed out on roughly $5 trillion in wealth. That's the cost of this depressed growth. So while it's true that the economy is growing, it's growing well below its potential, and that's why I argue we're in a depression. And just as Japan experienced its lost decade from 1990 to 2000, we could say we're in a lost era ourselves. Japan has now been dealing with slow growth for nearly 30 years, and there's no reason to believe that the US or Europe won't experience a similar fate. A global depression isn't just a US issue. The same sluggish growth is evident in Europe and parts of Asia. The only outlier might seem to be China, but there are serious questions about the integrity of China's economic data. They claim to be growing at 7-8%, but much of that is driven by infrastructure spending, much of which is wasted. If you adjust for that waste and apply standard accounting methods, China's real growth might be closer to 3-4%. The point is that much of the world is stuck in this low-growth, high-debt trap. Debt is a major component of this global depression, and whether debt is good or bad depends entirely on context. Debt can be productive if it funds investments that yield returns greater than the cost of the debt itself. However, debt becomes dangerous when it is used as a substitute for real growth, when it's simply a way to paper over problems rather than solving them. This is exactly what we've been seeing. Debt is rising faster than GDP, a clear sign that it's unsustainable. The global debt-to-GDP ratio is worsening, and we are edging closer to a potential debt crisis. So where does the Federal Reserve, Fed, fit into this picture? The Fed is in a tricky spot. They are raising interest rates, what's called tightening, 4 times a year, usually in March, June, September, and December. They've indicated this pace will continue unless one of 3 things happens. 1. A disorderly decline in the stock market. 2. A sharp rise in unemployment. Or 3. Deflation. So far, none of these pause factors have materialized. The stock market has been volatile but hasn't crashed. Unemployment remains low, and inflation, while ticking up, isn't out of control. But here's the rub. The Fed is over-tightening. Besides raising interest rates, they are also reducing their balance sheet. This is a process called normalizing the balance sheet, which basically means they're trying to get rid of the massive amounts of bonds they bought during the 2008 financial crisis. But reducing the balance sheet while raising interest rates is like applying the brakes and cutting the fuel line at the same time. The Fed is walking a tightrope here because if they tighten too much, they could trigger the very recession they're trying to prepare for. Historically, when the U.S. economy enters a recession, the Fed cuts interest rates by about 4 percentage points to get things moving again. But with current interest rates nowhere near 4%, they don't have that kind of room to maneuver. If they cut rates down to 0, they're effectively out of options. Negative interest rates have been tried in Europe and Japan, but the evidence suggests they don't work very well. If the U.S. economy falls into a recession and rates are already near 0, The only other option is to print more money through quantitative easing. The problem is we've been down this road before. QE, as practiced in the aftermath of 2008, pumped trillions of dollars into the economy, but it didn't generate inflation or a broad economic recovery. What it did do was inflate asset prices. Stocks, real estate, and other assets soared, but the underlying economy didn't improve as much as you might think. If printing money only inflates asset bubbles, then when the Fed tightens and destroys money, those asset prices are likely to fall. This is why many analysts are bearish on stocks in the long run. Meanwhile, gold has been holding its ground, which is surprising given the tightening environment. Typically, when interest rates rise, gold, which doesn't offer interest payments, tends to lose value. However, the fact that gold hasn't fallen dramatically suggests that investors are hedging against the potential for future financial instability. If the Fed has to reverse course and lower rates or restart QE to combat a recession, gold could surge. The moment the Fed signals that they can't normalize rates or the balance sheet without crashing the economy, gold will shine. Now, let's shift gears and talk about the forecasting models used by Wall Street and the Fed. They've been consistently wrong for years. The Fed, International Monetary Fund, IMF, and most big banks issue annual forecasts for GDP growth, inflation, and interest rates. And year after year, these forecasts miss the mark, sometimes by wide margins. In fact, there's solid research showing that economists are worse at predicting the future than random chance. You could ask a monkey to pick high or low growth, and you'd get a better result. Why? Economists often rely on flawed models that assume markets are efficient and prices move smoothly, but that's not how real-world markets behave. One issue is that traditional models assume that markets are in equilibrium, that supply and demand are balanced, and that shocks to the system are temporary. But financial markets aren't stable systems. They are complex systems that behave more like living organisms, prone to sudden, unpredictable shifts. The 2008 financial crisis is a good example of how wrong traditional models can be. None of the major institutions saw it coming, despite all their sophisticated tools. But complexity theory, which views the economy as an interconnected system with feedback loops, shows us that the bigger the system, the more vulnerable it is to catastrophic failure. Think of it this way: as the global financial system has grown, so too have the risks. Debt, derivatives, and financial concentration, where a few big banks control most of the assets, have all increased since 2008. In fact, the 5 largest U.S. banks now control a higher percentage of total assets than they did before the last crisis. The risk hasn't disappeared. It's just been moved around. And when the next crisis hits, it will be much worse because the system has grown exponentially larger. So what happens when the next crisis arrives? Bailouts will be bigger, but who will bail out the central banks? The answer lies in the IMF, which can issue a global currency called the Special Drawing Right, SDR. The SDR isn't money in the way we usually think about it, but in a crisis, it could become the world's reserve currency. If central banks run out of options, the IMF will step in to provide liquidity on a global scale. This could trigger a global monetary reset, where the global financial system is effectively rebooted, and the SDR plays a more prominent role in the international monetary system. But here's the scarier thought: central banks don't know how to handle deflation. While they can combat inflation by raising rates, deflation is a different beast. Once deflation sets in, it's self-reinforcing. Prices fall, which reduces demand, which makes prices fall even further. Central banks can lower interest rates to zero, but that only takes you so far. QE doesn't work because banks don't lend the money out. They just sit on it as excess reserves. Negative interest rates might work in theory, but in practice, they haven't provided the stimulus needed in Europe or Japan. We've seen deflation before, during the Great Depression from 1929 to 1933. Franklin Roosevelt took drastic steps, like closing every bank in America, to combat it. The lesson from history is that deflation is far harder to stop than inflation, and if it returns, central banks might find themselves out of options.